नमस्कार साथीहरु, वेलकम all of you to my channel, that is the finance guru Pawan Kumar Jha. आजको डिस्कसनमा हामी चाहिँ that's how to perform account receivable analysis को बारेमा छलफल गर्ने छौं. That's all about the financial accounting course, either in undergrad level, graduate level, and even in the professional examination like a CA, ACC, and other one. This is the common one when you are asked to analyze the receivable, and even we discuss the same content, similar content, you can say that under the corporate finance, financial management, friends. Okay, based on this background, now just discuss about what about the term that is a credit term, friends. Our credit term bandakari, this is all about let me clarify about the 2 by 10 net 30 means what. As we know that, friends, we sell the goods to the customer on the credit, then there is a need of receivable analysis before deciding about credit sales. Okay, so concerning the credit term, that is all about, if we say that 2 by 10 net 30, that means if the customer would pay within 10 days, would enjoy the 2% cash discount, while total credit period, or you can say that net period, is 30 days. That means beyond 10 days, if the customer would pay the dues figure, customer will not enjoy the discount. So in that case, we say that the analyzed cost of trade credit, which could be calculated by using this formula, that is the cost of trade credit, that is the discount percentage divided by 100% minus discount percentage, 365 days, that is the within a year, we say that total days, credit days, we say that minus discount days. So how we are going to find it? Before that, let me clarify about what about the cost of trade credit, which is also known as annualized cost of trade credit, or we can say that effective interest rate. That means if the customer decide to forego an early payment discount, that means if the customers unable to pay within 10 days, then what could be the cost to the customer? Okay, so that means if the customer prefer to pay an invoice on the net due date, that is the 30 days. So in this case, how we are going to find the cost of trade credit? Okay, that is the effective interest rate, we say that. So simply we can say that we could use this equation as I explained earlier. So discount percentage, you could see this is the how much we have, 0.02, that is a 2% divided by is 100%. Since I'm taking the, let's say the 1 minus 0.02, okay, I could use the 2 bracket, then we say that into, then we have a number of days in a year, that is the 365 days. Okay, if you are given in the weekly period, then we could use the 52 weeks like that. Okay, now what about the total credit period? That is the 30 days. So 30 minus discount days is the 10. Okay, again we can use the next bracket, then into 100, friends. So that means we would have a how much is the cost of trade credit? Effective interest rate. Now we can reduce the disk is the 37.245, friends. Okay, so that means this is the cost to the customer. If the customers are unable to pay within 10 days, that will be the, simply we can say that effective interest rate to the customer. Okay, so now let's talk about what about the case of days sales outstanding, DSO, which is also known as receivable collection period. Simply when you define the DSO, this is the simply how long it will take to collect the receivable. That means average number of days it takes the company to collect the payment after credit sales, that is a receivable. Now how we are going to find the day sales outstanding? This is simply account receivable divided by total credit sales into number of days in a year. Okay, if this is given in the week, a month, you have to just modify your equation. In alternative way, we can use DSO is the number of days in a year divided by receivable turnover ratio. Okay, which measure, that's the receivable turnover ratio measure how efficiently a company collect its receivable from customer over a given period, that is the like a year. Okay, now point is that you have to understand this one. Higher the day sales outstanding means the chances of bad debt, yeah, probable bad debt would be higher. Okay, so that means from the seller perspective, we we try to we try to provide the lower credit period. Okay, so that the chances of the bad debt would be minimized. Now the point is that how to reduce the day sales outstanding. First one is we have to establish clear credit policy so that we could at least through the proper credit policy we could design the effective credit terms for the customers. Next one is that offer partial payment for the large invoices. Okay, normally seller provides these facilities for inducing the early payment. If the customer would pay within 10 days, would enjoy the cash discount of 2%. If they could not, then there will be cost of trade credit. We see that. Okay, and the third one is that we have to collaborate with the sales team. Just we can't say that like finance people and account people are highly professionals. No, there must be the good coordinations among the marketing professionals or sales team, we can say that. Okay, now let's talk about what about the case of why credit analysis, friends. Why there is a need of credit analysis? So first point we can say that that is the case of is the probability of risks of default. Risks means which we could quantify, that is the probability of default. Uncollectible account. Okay, so concerning uncollectible account, you have to understand we have a two methods here. One is the direct right of approach, under which we have a credit sales, and over the due period of time, if the customer could not pay that dues figure, then simply we write off that account. So this is the direct right of approach. We confirm that that amount would not be recovered from the customer. And second one is that allowance approach, under which we have a two methods again. One is percentage of net credit sales. Net sales means gross sales minus return and allowances, that is the net sales, we say that. And the second one is that percentage of account receivable aging methods. Simply you could understand this one, that is the net credit sales, net sales into percentage we could apply to estimate the probable bad debt, that is the uncollectible account expenses, which is simply we can say that that is the balance sheet income statement approach. Okay, now what about the balance sheet, this one, this is the case of account receivable approach. Okay, that's aging methods, under which we say that certain percentage of the receivable would be uncollectible. But point is that we are not going to adjust any beginning balances that we might have in the previous year. Okay, which we could adjust here under the receivable approach. That means when we have a current debit balance, we add it. At the same time, when we have a current credit balance, then again we see that that is the subtract, we less it. Okay, so you could find this picture from the wonderful book that is the Powers and Needless Financial Accounting. Okay, page number 342. Now let's talk about what about the case of B number, that is the guiding pricing and the credit terms. Normally based on the credit policy we have to set, yeah, we have to clarify the what could be the guiding pricing and the credit terms. Okay, so that is the case. C is the case of the 5C, that is the character, capacity, capital, and this is the third one. And what about the D number? This is the collateral, and the next one is the conditions. Okay, so character is all about we have to understand, yeah, analyze the character of the customer, their past behavior. Okay, based on the experience we could at least understand. Otherwise, if you are dealing with the first time with the customer, then particularly we don't want to sell the goods on the credit, okay, without knowing the character. Next one is that capacity. We have to check the customer's capacity to meet the financial obligations, okay, yeah, dues figure. C is the capital. It's capital position we are talking about, that's the net worth. Asset minus liability. What's about the net worth position of the customer? D is the collateral, that is security part. And E is that condition. That's condition is all about is the overall economic condition. We can say that financial condition of the customer. Similarly, while doing the credit analysis, we have to also consider the regulatory compliances. For example, in case of banking, look at the compliances about the central bank. Okay, in banking term, we see that that's a non-performing loan, while in generally in the credit sales, from the business perspective, we are saying that's a bad debt and yeah, or uncollectible account. So is the last one is that strategic growth, and accordingly we could at least understand how to grow our business. Okay. So now let's talk about what about the credit risks. What may be the driver of the credit risks? First one is that probability of default. If we assume that yeah, probability of default of the customer would be higher, then you are going to charge more since you are taking the more risks. Okay. Similarly, loss given default and exposure at the default. What type of risks would be there? Okay. So as I explained earlier, that's all about under allowances. We have a percentage of sales. Next one is the percentage of receivable. First one is emphasis on the income statement relationship. Next one is the balance sheet relationship. Now, if the question is about, friends, can allowances for doubtful accounts have a debit balance? How would that happen? Main point is that as a credit officers, when you underestimate the probable bad debt, let's see the previous year, then in that case you would have a debit balance. And a debit balance, what we do while estimating the uncollectible account, we add it. Okay. And at the same time, that is the case of we say that what about the case of when we overestimate probable bad debt, then in that case you would have a credit balance, we subtract it. Okay. And accordingly we record a journal entry as a bad debt expenses or uncollectible account debit, uncollectible account expenses account debit to allowances for doubtful accounts, or we can say that provision for doubtful account. Okay. This way we could at least analyze the receivable part, and this all data we could get it from the annual report of the concerned company. Okay friends, these are the things that I would like to share today. If you like this content, please like, subscribe, and don't forget to subscribe my channel, that is the Finance Guru Pawan Kumar Jha. Thank you all of you for watching this video. Please take care all of you. Thank you.